So we see a lot of increase, construction cost increase, property price increase, mortgage increase, okay? Slowdowns are rent and of course land acquisition. So as an investor, what should we be looking out for? So without further ado, let's jump on to the first topic, which is new launches are back, okay? So this is an article by CNA that talks about there were 21 launches that happened last year. And analysts predicted that there will be about 30 to 40 launches in year 2023. So this could add another 10 to 12,000 new homes in the new home segment. So to give you some context of 21 launches last year, that actually equates to only approximately 5,000 homes, new homes, okay? So this year round, we are seeing double the amount, which means we would know that the fundamentals of transaction volume equals price appreciation. We are seeing it in year 2023. That's why a lot of new price benchmark has been done or released by the developer. So with that, we then talk about what are the 40 over launches that's happening in 2023. And just like all my masterclasses, people will usually be doing screen grab at this time. Okay, I believe that will be you as well. So I always like to go back to the origin of where these land were acquired in terms of manner. So we then see by way of en bloc and collective sale, we see a total of 31 of them by this nature. And this is important because whenever an en bloc were to happen or collective sale were to happen, it takes longer time to be released back to the marketplace. And in this instance, I use it the replenishment effect. Okay, so when you relaunch the marketplace, it will usually take about 18 to 24 months. Alright, so in today's context, there were only 3 developments that are relaunched since the very onset of the en bloc cycle that started back in 2020. So the 3 developments were Sophia Regency, okay, that was started along approximately end of last year. We see a 38 units development that launched but without any units sold. And the price tag was going as high as $2,008 or even $2,900 per square foot for Mount Sophia area. So hence, the developer did not sell any unit, okay? So again, when I say that en bloc, when they replenish the market, they always create another level high. So the next one we have is basically Terra Hills. So that's the former Flynn Park. And we saw how prices were launched between 2005 effectively, but went up to as high as 2008 or even 2008, yes. Okay, mediumly they were going about 2007. And for this kind of price tag, because it's freehold, people are willing to pay for it. It is also part of the greater southern waterfront transformation. And next, we are also looking at Chante or rather the former Surrey Point. The sales is also not as great, and we are seeing the price tag of even Newton area hitting around per square foot of 2008 per square foot compared to the last launch before this en bloc so-called cycle. Okay, we see Copa were going in about what 2004 per square foot, and people were saying back then it was expensive. And looking at the replenishment now, they have some benchmark of the so-called potential headroom for growth. Okay, so with that, we also look at the way of government land sales. There were only about 12 of them. So in terms of product launches in the marketplace, you could see that, you know, even though there are so many so-called development were supposed to launch, they are all not ready because mostly are under the en bloc segment. Alright, so you could get some sensing of, hey, you know, there's a lot of launches, but how come not so many? In fact, there's one that's coming in the next 2 weeks, which is the Continuum. That is also the former Thiam Siew site. That is also by way of en bloc. So prices will also be slightly higher than the other 2 sites as well. That is currently happening in the D15 area. So when we break it down into different so-called regions, this is how it looks like. And in the core central region, we see there is approximately 11 sites in this precinct. And in the rest of central region, we have about 16 of them, and mainly are clustered within the eastern side of Singapore. And on the outside central region, we have the opposite, where we are mostly in the western side, along with a few in the northern area, which is the very much talk about new township of Lentor area. Okay, so moving ahead in 2023 market outlook. So this is by some of the so-called media coverage that we've seen. First thing first is consultancy agencies such as CBRE and also our very favorite Stack Homes, okay, child reason to be happy or scared, okay, in 2023, and even Dollar and Cents on the financial so-called editorials as well. So over here in short, what they have summarized is rent will slow down. And why? Because in this year, we will see a lot of product that were delayed in construction getting their keys. So this year, we really see a few so-called mega development that has collected keys such as Park Esta, Jadescape, and even Sterling Residences. These are all 1,000 over units development, all right? And economy will slow down, mortgage rates will still increase, construction costs will increase, slowdown in land acquisition by developer. That means developer is not so optimistic. And then property prices will still rise. So we see a lot of increase. Construction costs increase, property price increase, mortgage increase. Okay, slowdowns are rent and of course land acquisition. So as an investor, what should we be looking out for? So when will go slow down, it means that capital gain is the key way to profit. Okay, especially with high interest rate. So over here we talk about rent will slow down. What it means is capital gain is still the key way to profit, especially with high interest rate right now, and we talk about normalized rate to be about 2 to 2.5%. Okay, so even if we were to move towards a so-called lower interest rate environment, you want to make sure that rent slows down, but capital gain is something that we are going to push you across, especially when it comes to property investment. Okay, so we are looking at about 4 to 5% annualized gain if we get it right under the urban transformation so-called strategy. So that will effectively offset your normalized rate in the future of 2 to 2.5. Okay, so economy will slow down, mortgage rates still increase. So what happened? New launch will give you the better leverage. Why so? Because if you're buying a so-called completed property, you will be going at full disbursement of your interest already, which means you get a full effect or full brunt of the 4%. But if you are buying, of course, the new homes, you only feel a bit of it because it's by progressive payment. Okay, so they give you the better leverage. Construction costs will increase, which means driving up selling prices by developer as well. Slowdown in land acquisition by developer. So what does it mean? It means that developer already see the current en bloc and also government land sales program that happens in 2023 and before to be filling up the supply in year 23 and 24. So effectively, oversupply may happen in year 2025. And property price will still increase, and we are seeing approximately about 3% this year based on new benchmark prices. Okay, so will it be 3% or higher? So this is what we will be uncovering with you today.